Welcome, aspiring financial detectives. Today we're going to unravel the mystery of bond investing and have a strategize based on the clues the market gives us, specifically regarding interest rates. Imagine you're a financial detective trying to decide how to invest in bonds. The first big question you need to ask yourself is, what will happen with interest rates? This is our crucial first clue. Let's explore two possible scenarios. Just like a detective follows different leads. Scenario 1, interest rates are expected to rise. What does our investigation tell us will happen to bonds? Well, when interest rates go up, the value of existing bonds with lower interest rates becomes less attractive. Therefore, bond prices will fall, and conversely, the yields will rise to compensate. So as a savvy financial detective, what's our strategy in this situation? Our flowchart suggests 3 key actions. First, avoid long-term bonds. Why? Because long-term bonds are more sensitive to interest rate changes. If rates keep rising, the value of your long-term bond could decrease significantly. Second, prefer short-term bonds. Short-term bonds mature more quickly, allowing you to reinvest at the new, higher interest rates sooner. And third, wait for yields to rise more. By holding off on long-term commitments, you can potentially capture even higher yields as interest rates continue their upward trend. Now let's consider scenario 2. Interest rates are expected to fall. What happens to bonds in this case? When new bonds are issued with lower interest rates, the older bonds with higher rates become more valuable. This means bond prices will rise and the yields will fall. As our financial detective brain kicks in, what's the smart investment strategy here? First, it's generally considered a good time to buy bonds. With the expectation of falling rates, the value of bonds you purchase now has the potential to increase. Second, prefer long-term bonds. These bonds will lock in the higher interest rates for a longer period, and they also tend to appreciate more in value when interest rates fall. And finally, you can aim to lock in high yields plus capital gains. By purchasing long-term bonds with attractive current yields, you secure that income stream. And as rates fall, the market value of your bonds may also increase, leading to capital gains if you decide to sell. So there you have it. Just like a financial detective observes the clues, in this case, the anticipated direction of interest rates, you can develop a strategic approach to bond investing. Remember, this flowchart provides a general framework. Always conduct thorough research and consider your own financial situation before making any investment decisions.